y Asociados offer a wide range of services for companies interested in investing in Spain. These include tax advice, auditing, consultancy, labour law advice, and accounting management. So now, if I just take a moment to introduce our speakers. Joining us from Madrid, we have Beltran Sanchez, who is the Transfer Pricing Director at Bove Montero y Asociados. Beltran has 15 years' experience in transfer pricing consultancy at firms including PwC and most recently Deloitte. His areas of expertise include offering integrated advice on transfer pricing policies, representation in tax inspection proceedings, assistance in mutual agreement procedures and dispute resolution, with a particular focus on international groups. We're also joined by James Dolan and Alejandro Abad Algara from Blick Rothenberg. James is particularly experienced in advising US parented groups, establish UK and European operations, and on international tax and transfer pricing relevant to US parented groups. He joined Blick Rothenberg in 2017 as an international tax partner. He has over 15 years' experience in advising on international tax matters across a range of industries and sectors. Alejandro is a corporate tax assistant at the firm, and his areas of expertise are transfer pricing and corporate tax. Previously, Alejandro worked as an associate tax lawyer for Spanish firm Garrigues. So now we're going to have the presentation from all three of the speakers, and at the end of that, there'll be plenty of time for you to ask in your questions. To do that, you'll see at the bottom of your screen there's both the Q&A and the chat function, so please feel free to write into either of those. And after the presentation, there'll be plenty of time for you to ask any questions that you might have. Okay, great. So now without further ado, I'll hand over to you, Beltran.
So hello everyone. In first place, I would like to thanks the chamber to take the opportunity to organize this webinar and to bring so good partner as Blick and Rothenberg. So we will talk during the webinar about, well, the value chain analysis within Spanish and the UK investments and, well, its relations with the COVID implications in first place. So if we talk about COVID and transfer pricing, we could have a lot of different topics now, but we would like to focus on the fact that a lot of transfer pricing policies have been based on forecasts and projections that right now they have changed drastically. That means that probably the transfer pricing policies in place does not provide the results and the effects that were looked at the very beginning when they were settled. So and you know, during these months, I think every or almost every company have passed through a process whether they have started taking defensive decisions just to guarantee liquidity, solvency of their companies. So these decisions have nothing to do with transfer pricing. Nobody probably from the transfer pricing teams, or it's difficult due to the the speed that needs to do this decisions and this implementation were done. You know, probably this implies that not a lot of transfer pricing analysis have been done. The objective was different, and I think in every company business leads. So this is the first step. You know, this kind of decisions probably were taken during the first months of this COVID circumstances. Then just in summer and during these months until the end of the year or first quarters of the next years, probably we would be fixing things that has happened, not just for guaranteeing the continuity of the business, but in order to solve problems that have happened from this economic situation. Okay, and again, it is important to take a look to that decision from a transfer pricing perspective. Normally, these decisions, well, normally we are seeing that these decisions are being analyzed from a transfer pricing perspective. And when I mean this, I mean services that companies are having losses. Companies asking, should I charge the service? Should I not charge? Should I don't know, change my TP policy? I don't know, a lot of plenty of different cases. But then the future probably would be, and we are all hearing about big changes on the way that companies uh, will do business in the future. We're hearing about supply chain changes. We're hearing about a lot of things, and probably the end of this pandemic situation ends with a huge amount of reorganization of companies, leading by the business and financial experts. But um, the big point here is transfer pricing should be involved in that changes, in that processes. Why? Because we could be losing opportunities, but we could be creating future problems if we do not align or transfer pricing practices with the new situation of the companies. It is important to review transfer pricing topics from a high level perspective and not transaction by transaction, because um, in order to identify the effects and implications of such changes, it's important to have an overview of the full transfer pricing policy and group, so about the value chain. And well, I think even if these changes are not so drastically in the companies, it would be important to review if the transfer pricing models in place are still valid with the new situation of the companies. Okay, I think this would have a very huge impact on transfer pricing policies. So I don't know, James, if you have any comments on this.
Yeah, thank you, Belshman. I mean, just to sort of add that from a UK tax and transfer pricing perspective, the tax authorities here, which I would call HMRC, they're very focused on whether the allocation of profit is aligned to the economic activity that produces those profits, and that really requires a full understanding of exactly what you're referring to, of the value chain and any changes that have happened as a result of COVID. So just to really kind of agree with what you're suggesting and explain that in the UK, that is the most important piece that we spend as a firm when preparing transfer pricing documentation. And really it's what HMRC, the tax authority here, will spend their time reviewing as well. The tax authority here will only accept a one-sided transfer pricing approach when they've understood the entire value chain. So that is the starting point. And COVID does create change, and it creates a different allocation of the functions, assets and risks. So all of that needs to be reviewed and looked at, which I think is what you're about to come on to now.
So basically, when we talk about transfer pricing, we normally think in the price of the transactions that probably are the consequence, the conclusions of our works. But I think there is a quite number of elements that should be reviewed and considered in any transfer pricing analysis, that probably COVID and any restructuring, but COVID will force restructurings and changes in the organizations, could disalign. I think when we speak about functions, we should look at the employees. We should look also at the ways of working. We should look at the agreements. If those agreements are still reflecting the reality of the business, the capacity of the IT systems. A lot of times, people want to do implementations of new ways to do their business, and the IT does not support that ways. Then it comes the financial results and the transfer pricing policies. That would be a consequence of all the previous factors. But it is key that all these factors are aligned, and obviously in any changes on the model, on the ways of doing business, and as I've told, I'm quite sure that COVID have produced changes and in almost every jurisdiction and company. This is something that should be reviewed, supported, and realigned if there is misalignments. Okay. Again, I want to highlight the importance of doing transfer pricing tax analysis and financial planning when all these changes will occur. If companies knows the model that they want in the future to carry out their business, it is important also to review and to know what is happening right now, and something that is not so obvious, but it's also necessary from a transfer pricing perspective, is to create transition models, because all these factors that I have commented does not implement at the same timings. Probably to change an agreement is quite easy, but it's not so easy to change people roles or to change people from one company to another. Even more difficult to change people from one country to another, and even more difficult to change IT processes and IT systems. So probably when these changes occur, and some of them are not intended within a planification, some of them have just occurred and nobody in the companies know it, and this should be reviewed, and a transitional plan should be done in order to guarantee that the travel to the to-be model, to the model that we want to do, that we want to be in the future, are duly implemented, and that during this process there is no risk or there is no misalignments that could generate disputes, etc. The risk of avoiding all of these analyses probably are, you probably know all of these topics, but permanent establishment is something that when things changes should be analyzed. Exit taxes and recharacterization of companies and changes, adjustments or challenge to the transfer pricing policies. I don't know, James, if you want to add something here.
I think what we're seeing with many groups that we work with is that they've had transfer pricing policies and documentation in place now for some time. And really COVID is perhaps the first opportunity for them to sort of reflect on that policy and whether it is still fit for purpose and appropriate. So they're investigating whether, substance versus form and whether there's been a change that now needs to be fed through into the model, exactly as you're saying, Beltran. And so I think we've got some clients who are changing the policy entirely. We've got others that are restructuring parts of the business or their supply chain. We've got others that are just tweaking where they sit within the range of their transfer pricing policies. It's the complete mixture of approaches from companies that we're seeing at the moment. And I do think it's a good opportunity to review not only the documentation that you have in place on the transfer pricing side, but also those intercompany agreements, and see whether, first of all, they allow you to make changes and how that would operate. And if you don't have proper documentation to put that in place with your legal counsel, we found for many cost plus entities in the kind of digital space, actually their businesses haven't been impacted, either because they provide software and COVID has actually increased their business, or because they're a routine service provider and it's very challenging for them to change the policy that they're operating within. So it is very specific to each group, and it does need to be considered holistically, as you've explained. The only other point I would add is Brexit is the other point that, aside from COVID, does seem to be creating a lot of change within business at the moment. So I think the same principles apply equally to Brexit as they would to COVID.
Okay, so changing a little bit the topic, we would like to speak a little bit about well, the trends and the approach of our tax authorities to transfer pricing. Okay, well, in first place, let's say that in Spain, transfer pricing is one of the main topics for every company that carry out related transactions. You know, even, and this is very important because many companies think that they are safe just because they have not done any tax planning, but that doesn't mean that they are safe. You know, it is important to review transfer pricing policies and to understand the impacts, the results, and the value chain as a whole. Not necessary for tax optimization purposes, but just in order to understand your transfer pricing policies and to put in place, well, let's say effective transfer pricing rules within the groups. Okay, you know, it's something curious because my experience, and I think from almost all my colleagues that I have speak with them, our experience is that when we start discussing with the tax authorities about transfer pricing, we discuss just very little about financials, about margins, etc. The main discussions comes about facts. You know, tax authorities in Spain are very active and very challenging in terms of understanding the facts, the business, and what the agreements reflects and what the transfer pricing documentation reflects. And we find that during a tax audit, I would say that 75 or 85% of the time talking about transfer pricing, we're discussing about facts, about who is doing what and what is the value of that is doing your counterparty. If this comes in a framework of a changing the organization or a changing the transfer pricing policies or any kind of changes that you want to reflect, this is even more complex. You know, there are huge changes within the organizations, within their ways of working, roles, reporting structures, reviews, decision-making processes, etc., that really are not well explained in most of the documentation that I have seen, and that if they are not very well explained, there is a big door for the Spanish tax auditors to not understand what you're trying to tell them as a big reorganization process, and then they would challenge the full picture. They would just tell you that this is not the reality of the company, and they would tell you the reality of the company, which is something curious. It's something that most of our non-Spanish clients really does not understand, because, well, it seems that they know, you know, you, the companies, know much better than anyone your business, but suddenly someone from completely a different status, industry, etc., comes and tell you how are you doing business, and this is something very challenging, really. You know, facts should be well supported from a transfer pricing perspective. I think this is the most key element when going before the Spanish tax authorities in an eventual tax audit. You know, the other topic probably is the one side versus two side approach. The the Spanish tax authorities normally just follow the one-side approach. They only look at the Spanish entity. It is their trend, but sometimes we, the advisors and the companies, force that because we're not giving them all the information necessary to do their assessments based on the information of the counterparty, the group, etc., because we're keeping information by its own. So at the end of the day, we're helping them to use the one-side approach, which is not the way of assessing transfer pricing. So let's have a discussion about cost and benefit of about what information to share with the tax authorities and what not. And just some news on Spain. You know, everyone must know that we're giving a lot of information to the Spanish tax, well, to the tax authorities all around the world through several mechanisms. And the topic here is that they have received so much documentation, so much information that is quite difficult to manage and to use. They are now starting to use, well, let's say, data analytics, but they're just starting to do hallmarks based on, trying to organize and use that data using targeting teams in order to identify their own risk based on the countries, the counterparties, the kind of transactions, such as cash pooling, services, intangible transactions, and based on the structure that the companies are implementing, principal versus limited risk distributors, commissioners, toll manufacturers, they know that these have been created using transfer pricing methodology, and they are going to review that entities, And the other last new from the Spanish tax authorities, or what we are hearing from them, is that they will start doing limited tax audits from a transfer pricing perspective that until the moment is not very common. They based on this data analytics or review or targeting teams or risk assessment, or how do you want to call it, they would identify things that they want to review, but not to open a full 2 years tax audit. So they would ask for a specific information, review that information, and take decisions with that information in place, which is, I think, something new that we will be facing on the next years.
Okay, so thank you, Beltran, for talking about transfer pricing from a Spanish perspective regarding tax authorities. So we have decided to compile in this slide the latest statistics published by HMC. They were published last month. And so if you look at the left-hand side of the slide, you will see the transfer pricing yield over the years. So these yield include the additional tax revenue that HMC have obtained from inquiries or advanced pricing agreements. And we can see how the trend has been increasing over the years. So when the statistics started back in 2014, HMC just got like around £700 million, and this has increased. The numbers in 2017-18 may differ slightly because HMC decided to change the way they made the statistics. But the key takeaway here is HMC are increasing their awareness on transfer pricing and the importance they are giving. And in fact, we can see on the right-hand side of the slide how the number of cases settled have also been very high, and how the average age of settled inquiries in months is also increasing over time. And this is basically because inquiries are becoming more complex over the years. And one last thing that I wanted to mention here is how HMC have had around 500 full-time employees in 2019-20 dedicated on international issues involving transfer pricing, multinational enterprises. So this is a very important thing for HMRC, and basically groups shouldn't overlook at this. So the inquiry process, well, Beltran has talked about how the Spanish tax authorities approach TP inquiries. So here in the UK, we've got something very similar as well. Basically, it all starts with the corporation tax. So when companies file them, and a corporation tax officer looks at them, if this officer identifies a transfer pricing issue, they will talk with a transfer pricing specialist of those that I have just mentioned in the previous slide, and they will decide whether or not they need to open a TP inquiry on the return. And if they decide so, this is approved by a specific transfer pricing office within HMC. So that proves again how transfer pricing is being looked in detail by HMRC. If this formal inquiry notice is open, then HMRC needs to prepare an action plan of how this inquiry will go, and this is basically done, or it is aimed to be done with collaboration with taxpayers. So this is very important, because this means that HMRC really wants to know what the taxpayer has done, and even if there is no tax flagging, as Beltran said before, it is really important to be able to explain to HMRC what are the reasons and why the transfer pricing policies have been put in place. And finally, after a few months, as we've seen in the previous slide, then the case is closed either without adjustments if HMRC are satisfied that the transfer pricing policies are okay, or either by way of settlements that you agree with HMRC, or procedure to litigation if there is no agreement. So what are the basic HMRC's risks indicators that they look at in order to open an inquiry? So the first one is the amount of tax at risk. Obviously, if they've got limited resources, if transfer pricing is becoming something really important nowadays, they need to look at the cases where they expect to get the most tax revenue from. Basically, because they publicly say in their guidance that they understand that these kind of inquiries imply a lot of economic and personal resources, both for HMRC and the taxpayers. And all the things that may be looked at can be, for example, UK companies' profit or losses appear inconsistent either with the business itself or the worldwide group over a cycle of, for example, 5 years. They compare, they want to understand whether or not this makes sense. Also, for example, if the UK company has got intangibles or provide the group with intangibles, but the UK company receives no income from those intangibles. Or, for example, if borrowing appears disproportionately high in relation to shareholders' funds, think capitalization, for example, and also even if the borrowing is fine, if the interest rate does not appear to be correct, transactions do not appear to make commercial sense as well. So there are intercompany transactions that looked from an economic perspective do not make too much sense. And finally, and this is really interesting, I also tie this to what Beltran was saying about all the information tax authorities have got in their power nowadays. Notes in UK accounts, for example, or press releases where groups say we are undertaking a restructuring, or we have changed this, or we have incorporated a new group or subgroup, may catch HMRC attention to look into the group's transfer pricing policy to check whether or not everything is correct. And now Beltran will talk about permanent establishments from a Spanish perspective.
Thank you, Alejandro. I will not talk a lot about this because I think we have more interesting things in the following slides. But just to mention, this is not new. You know, probably Spain has been one of the most active countries with respect to PEs and to the PE concept. You know, we have had a good volume of cases, court cases that have extended the framework where the PE approach it could be used. Probably the first of them very famous was the Roche case, whether well, it changes a little bit the framework of the PE, but at the end of the day, suddenly BEPS appear and brings this this artificial fragmentation concept, and I think that what the Spanish tax authorities and courts have been doing until that moment was a kind of using of that concept before it was included, you know, in the tax papers. The common point of all the cases was a restructuring process, whereas, well, some profits were relocated from Spain to a different country. So I think the conclusion of this is that the first thing that should be analyzed from a Spanish perspective, whether when changes occur within an organization, is to assess if there is a possibility to be challenged from a PE approach.
So I'm going to talk a little bit about specific rules that the UK introduced unilaterally to counter some of the points that Beltran and Alejandro have been raising. So the UK tax authorities for many years became quite frustrated with the way that transfer pricing inquiries were progressing. They felt that taxpayers and tax advisors were limiting the amount of information that was being shared, or perhaps in multinational groups, the non-UK or non-Spanish entities were not willing to share information, and it was very difficult for the tax inspector to understand that full value chain that we explained. In addition, there was a frustration around whether the old OECD guidelines really did attribute value to the functions that were being performed on the ground in the UK. And on top of that, there was a concern that many technology groups in particular were using offshore entities to conclude contracts with customers in the UK. And the UK was a pure sort of marketing and sales service provider and being rewarded under a cost plus. But under a pure definition of PE, the conclusion of the contract was happening outside of the UK, and so there was no way of asserting a permanent establishment or PE. So the UK, over the last 5 years, really has introduced 3 or 4 different new pieces of legislation specifically targeted at these arrangements. And now these are tax rules, but they're all designed to work alongside transfer pricing, and they all include transfer pricing concepts. And the reason I'm just going to briefly explain them to you is because whilst these began as being relevant to the largest companies, the largest listed groups and technology groups, over time, then the concepts and the provisions have extended effectively to all taxpayers. And the tax authorities have learned the lessons from these larger investigations and are now applying them to smaller and more sort of mid-sized groups. So I think it's worth spending a few minutes just explaining them at a high level. The first one is Diversion Profits Tax. That came in 2015. Specific legislation really targeted at contrived arrangements that divert profits from the UK to low tax jurisdictions where little or no tax is being paid. And that was targeted at 2 situations. The first one is an avoided permanent establishment, as I just described. And then secondly, transactions with entities in a group that lack economic substance. Now, this is a new, for the UK, this was a new a tax that fell outside of UK corporation tax. It was a punitive 25% rate, so much higher than the current 19% corporation tax. And it allows HMRC to recharacterize a transaction under an alternative provision to effectively reattribute certain assets back into the UK tax net. So as an example, if a group had some valuable intellectual property and moved that property outside of the UK to a low tax or low substance connected company, these rules could in theory reattribute all of the income from that intellectual property back into the UK tax net. So very effective rules with some interesting provisions that allow the tax authorities to charge the taxpayer upfront and require payment of the diverted profits tax within 30 days, and then allow the taxpayer effectively to enter into a period up to 15 months where they can argue for some of that cash back from the tax authorities. So really kind of flip the dynamic on its head. This has been very effective for HMRC. Often the outcome of the inquiries was a transfer pricing adjustment and or a change in the group structure, perhaps moving from a low tax, low substance jurisdiction into the UK or some other higher tax jurisdiction. The tax authorities have a large number of teams working on this. I think it's eight DPT teams, all involved and very experienced in these type of investigations. There's over 100 ongoing at the moment, 80 successfully completed. And this has fed into the higher tax take that Alejandro explained in terms of those statistics earlier. Now, some of the interesting points to learn from these inquiries that we've been involved in and that we've had feedback from HMRC on of things that have led to an adjustment for transfer pricing. It's things like groups not reviewing their TP policies regularly and keeping them up to date, not doing a full UK functional analysis, but relying on an EMEA-wide assumed functional analysis. So therefore not really having policies that are reflective of what's going on in the UK. Using the wrong cost base for a cost plus methodology. So perhaps not including things like share options, equally having the wrong sales base for a sales-based TP model, perhaps not including non-UK sales when you've got people in the UK who oversee and control sales outside of the UK. So there's been a lot of adjustments as a result of this. And I think HMRC would say it's been a success. It's led to a change of behaviour. However, these inquiries rumble on for 2 or 3 years, as shown in those statistics. And so to encourage taxpayers to be more cooperative, HMRC launched number 2 on this slide, the Diversion Compliance Facility, which is effectively a notification facility where a taxpayer can go to HMRC and agree to enter into this facility, and then produce a document really that outlines the current pricing, and if there are any changes that are required, agree and discuss that with HMRC, and then pay any outstanding tax. And really the benefit for the taxpayer is more control over that process, potentially a shorter period of time before it gets agreed, the ability to bring your affairs up to date, and potentially lower penalties or no penalties if you do this proactively rather than HMRC reaching out to you with an inquiry. Now, interestingly, HMRC have issued multiple rounds of nudge letters, so writing to large taxpayers saying that they HMRC consider that the group has potentially diverted profits, and then allowing that company still to enter into this facility. And the uptake on those nudge letters has obviously been very, very high, and led to a number of, again, tax adjustments. So those rules tended to apply to the largest groups and not what I would call SMEs within that European definition. And as you may know, in the UK, full transfer pricing rules don't apply to groups that are within the SME regime as well. However, because these rules on diverted profits have been so successful, the UK last year, in 2019, introduced profit fragmentation rules. And these rules really do extend all of these concepts, including transfer pricing, to all taxpayers, whether individuals or smaller companies. And I think this is going to be the key thing for the next few years. This is effectively allowing HMRC to just broaden their inquiry profile. And I think it's an important point that all groups now do reflect on their intercompany transactions and look at that value chain and price things correctly. So here we've thought we'd try and pull this together into a couple of case study examples. And the one we've drawn up first is a very common structure where a group is first expanding into the UK, and you could equally flip the countries round if you wanted to. Here you've got the Spanish parent company that recognises all the sales income. You've got a UK wholly owned subsidiary that has a couple of people on the ground, and perhaps they're providing either routine marketing and business development services, or perhaps they're doing some routine research and development work under the direction of the parent. And the UK is rewarded under a cost plus model. So very common structure, one that increasingly we are seeing tax authorities dislike. On the sales side, particularly, there's an importance of reviewing what the people on the ground are doing and whether they are in effect agreeing contracts or negotiating, because if they are, that could create a permanent establishment, as Beltran explained earlier, in which case you have to attribute profit to that permanent establishment. And there's then a question as to whether that is equivalent to the cost plus fee that the UK is receiving. And then equally, if it's R&D being performed in the country, is that really routine, or actually is it value adding? And perhaps there are some more senior R&D or CTO type functions in the UK, in which case that the tax authorities here are going to want to see future profits being attributed to the UK. So this is a hot topic among groups expanding internationally. We are having many conversations with groups about whether this structure is sustainable, whether it's appropriate, whether it should be adjusted to reflect changes to the roles of the people on the ground, or whether perhaps a different model altogether is more preferable. So perhaps a reseller or distributor type model where contracts are concluded locally, or perhaps some kind of commission on sales if you've got UK-based salespeople. There's lots of things to talk about here, and Beltran, I'd be interested to hear your thoughts on this from a Spanish perspective. I'm sure you've come across this a lot as well.
Yeah, I think in first place, I agree that this is a very common structure. We're seeing a lot of groups, emerging groups, groups that are starting to going out of their countries to establish this kind of policies, just cost plus, it's easy, it's well, they think this is sustainable because, well, the OECD and the forum, etc., have discussed about this a lot. But really, the important thing is what people is doing. And in the new business models that we are seeing, IT companies, software companies, internet companies, etc., which is also a very common structure. We should be, well, a little bit careful with this kind of policies, because there is a thin line in those companies about doing supporting activities than researching and developing intangibles. Also in infrastructure groups, we are seeing this a lot. People that comes to Spain start doing, well, I don't know, engineering things or services for other companies, etc. Well, let's be very careful with the kind of functional profile that these people has, and with the kind of activities that those companies has. And most of the times, just this to analyze the full value chain and understand if this is a cost plus, if this is a commission, if this is a limited risk distributor, or if this is just a fully fledged company that needs to be charged with every royalty service, etc., with the group, and needs to contract with their own region. But yeah, I would not say that cost plus is something safe, just so straightforward.
Yeah, I think it's one to review regularly. It's something that, as you say, things can evolve quite quickly, and having a regular review of that type of a model is really important. So here on case study 2, we've got a distributor. So here we've got effectively product being purchased into the UK company and then sold to customers. Clearly, this type of model could have been impacted as a result of COVID. Often, we've had conversations with groups where funding has been provided from the parent to the subsidiary to help support. But also, we're finding the UK tax authorities are looking quite carefully at the role of the UK in this structure, and whether, if it's positioned as limited risk, whether that's really reflective of the functions that are happening in the UK, and actually, if there is an arrangement whereby product is purchased from the parent at a fixed price, and then at the end of the year there is a transfer pricing adjustment, we're finding that tax authorities are looking at that from not just a transfer pricing but a customs perspective as well. So I think it's important to not forget customs duties and indirect taxes when talking about these type of models. And then in terms of things that groups are doing, looking at the margins and whether it's possible to adjust them, given that the comparables are not going to be available for a few years, given that COVID is a new thing. Whether it's possible to tweak to some other kind of royalty that might be tiered or based on some other percentage of sales type model that might favour an adjustment now. So there's lots of options here for groups to think about, including what the external comparables look like. And I think it's just about, again, having those conversations and checking the intercompany agreements and making sure that you've got a robust and defendable position.
Well, I think this is just a very good case. We have had recently a case where a group, with recent group, they were implementing a policy that, it seems, if you look just the policy, it seems that it is a safe policy. It is a quite conservative policy, but when you go up and look the big picture, what you realize is that they were creating losses in every affiliate all around the world. They were making profits in Spain about 1.5 multiple of their real consolidated EBITDA. So at the end of the day, even it's necessary to do this kind of analysis. It's necessary to challenge if companies are well characterized, because you could think that you have a fully fledged distributor in a country, but when we are talking about distributors, volumes and capacity to expand their business are quite critical. And if they're not able to expand their business to reach sufficient volumes, and the policies leads them to make losses for so many years, even if you have comparables, etc. The most probable thing that could happen is that the tax authorities of any of these countries would come and tell you that if this is an independent company, would have closed so many years ago. So to these kind of questions, probably the answer from a pure transfer pricing perspective is, let's rethink if that's a fully fledged distributor. I think we're rounding around the same topic, but I think it's quite important. Yeah.
I think we can probably skip that page, Alejandro, and just move on to Beltran and number 3.
Yeah. Okay, so let's go quick for this in order to try to have some time for the Q&A. But we're receiving an important volume of questions related to global mobility of employees. And this, I think this is a consequence of the COVID. Well, I do not think it is a consequence of the COVID. Most of these topics are assessed from a personal income tax and other topics. But we want to talk about this from a transfer pricing and direct tax perspective, okay? And well, I would address mainly the PE issues that this could create, okay? Because this is a common question. Every client that asks us about this kind of structures, they tell us or they question us if they need to settle a company and establish a transfer pricing between the parent company and the people that have abroad in their countries. And I think there is no a clear-cut answer to that. You know, there is risk factors, and a very practical approach should be followed. You know, if we should look at how many people we have in that country, because even if we have, if they are just supporting developers, not working for clients on this country, etc. But if we have 25 people in a country, I'm going to the extreme, well, probably that's a P. If we are talking about functions close to the sales, well, that should be analyzed also. And if we're talking about directors or people performing high-level functions, or people very close to an intangible, sales intangible or whatever, we should analyze that, because we could find that we, at the end of the time, that we have a PE, and it's much better to establish yourself, the company, the transfer price, the profit allocation to the permanent establishment, than letting the Spanish tax authorities or a different tax authorities to analyze themselves and assess their own thoughts about the transfer pricing policies, because they would probably go for a much higher return on the functions located in the country that what the companies are really thinking that these people should be remunerated.
Yeah, I mean, I think here it's, you know, most tax authorities have issued helpful guidance to support that there might not be a PE during COVID, or that tax residents won't be considered. But it really does come down to the facts and whether there was a pattern of that type of behaviour before COVID, because if there was, then I think potentially you've got a higher risk situation, and whether it continues. But also, if people are in a new country, then that also means they're not in the country they were before, and they probably should have been doing a key role in that country that they should have been in. So it kind of works both ways. Is there a PE? But also, what about the country where they're no longer based? Does that affect the model? Because if they're a senior person responsible for the intellectual property, how does that fit with your transfer pricing if they're no longer in that original location that you've based your policy around? So those are some of the conversations that we're having, and they're all very interesting and quite challenging, to be honest. So Hannah, I think it's Q&A time. Did you have any questions?
Yep. Hi. Sorry, I just was, my mic's back working then. Cool. Thank you so much. That was really, really interesting, James, Bertrand, and Alejandro. Lots of really, really useful, relevant, incredibly relevant information there for all of our listeners. Okay, so if you have any questions, please do feel free to write them in. So there's the chat function, as I said before, and also the Q&A one. So please do feel free to go ahead. Great. Okay, so one question then to kick us off. I guess whoever of you would like to answer this, you can go ahead. Have tax authorities stopped raising transfer pricing inquiries during the coronavirus pandemic?
I can go first on that one quickly. So the UK, many businesses were offered the opportunity to pause with transfer pricing inquiries during COVID. Actually, many of the larger businesses preferred to carry on and proceed with the engagement on those. And HMRC have been very fair with business and have been kind of, adjusting timescales and responding timescales to help business. So they're now getting back on track, I would say, and they're, as I mentioned on some of those initiatives, they are issuing new nudge letters and other inquiry letters. So it's pretty much back to business, but they are distracted, let's say, on other things to do with Brexit and other large inquiries at the moment.
So in Spain, I think during the first months, you know, the first wave, let's call it that, like that, there was like a stop on almost all the administrative functions. They have continued working, targeting and assessing things, but you know, there has been like a stop in the requests from the tax authorities. But we have to have in mind that probably 2020 is a year that a lot of companies will be making losses, and you know, in Spain they have 10 years to review the losses. So I think probably in the next months, years, we would be seeing a quite increase on the transfer pricing inquiries from the Spanish tax authorities.
Great, thank you very much. We've got a question here that's for James, which is how will Brexit affect the pressure and transfer pricing from the UK authorities?
Yeah, I mean, it's a great question. I mean, the things that we're seeing at the moment are mainly groups restructuring to try and give them a post-Brexit structure that works for them commercially. So that depends on what industry and sector you're in. Some groups are pretty much unaffected if they're technology and you know, really it's only talent that then they're interested in. Whereas a pharmaceutical group or a insurance group or a bank, you know, very affected by Brexit. So it's very different depending on sector. But I think the most interesting things we've seen around Brexit from a TP perspective are whether you're, if you're restructuring the business, perhaps to set up a branch or a new operation in Europe for certain functions, whether you've transferred intangibles out of the UK or out of your home jurisdiction, and how you price those. There's been some very large projects around that across all accounting firms in the UK. And that's a really difficult area and it needs to be looked at depending on what you're transferring and where to. But then also there's general supply chain transactions which need to be thought through from a transfer pricing perspective. So if you're opening a warehouse in the UK or in Europe, are you having any people there? Does it create a permanent establishment? Should you be attributing some profit there? Because when you look at other functions going on in that country, perhaps you do breach certain thresholds. You know, does the change in supply chain for EU or non-EU impact your current model in any way? So there's a whole range of TP aspects there, and HMRC are very, very familiar with them. And on those larger restructurings, they're having open discussions with the largest groups on those actively at the moment.
Brilliant. Thank you very much, James. Another question we've got is, what are the key factors that, from a transfer pricing perspective, that must be considered when a company is planning to restructure its business model?
Well, I think I could take the lead on this one. I think first thing that should be addressed is business reasons. You know, any restructuring should match business expectations. Well, it should begin from a business perspective. Then we could look at the feasibility of some options. But I think the main challenge that I have found in the business reorganizations that I have worked for is to trying to align the expectations of the business with the expectations of the financial guys about taxes. So business goes first always. Tax should follow. So let's see is the model that business wants to implement. Let's find on that model the most suitable transfer pricing model, the policy, and I think that's the most important thing on a business restructuring. Then it would comes the IT, the agreements, etc., and you probably the groups needs to look at about a lot of factors. But if business fits taxes, or if taxes fits business, I think the main issue of the restructuring would be safe.
Brilliant. Thank you very much. Would James or Alejandro anything to add, or is that sufficient?
I think that's fine. Let's do one more question, Hannah.
Yeah, okay. Okay, well then a good one that we've got here to finish on is, what key messages would you like to leave for our participants today?
I mean, I think from a UK perspective, and it's all about, I think, doing everything you can to prevent reaching the stage of an inquiry into transfer pricing. So, you know, making sure that you have reviewed and updated your policies and you have accurate functional analysis in place, that they've all been done on a kind of global value chain basis, so that you've kind of considered all the things we've spoken about today, and then have the right documentation, whether that's transfer pricing documentation, but also intercompany agreements that are prepared, you know, with the support of everyone in the business and legal counsel to make sure that you can robustly defend them.
I would say. No, please go ahead, James.
No, I was going to say, sorry, anything that you want to add on top of that?
No, I would say that just from a Spanish perspective, I think I have two messages. The first one is, let's think about transfer pricing when business decisions are taken, are quite linked, and things goes much better if both are taken at the same time and analyzed when the transactions are settled. And second message, I think quite similar to James' one, is things needs to be well supported. You know, tax auditors probably would challenge facts, so let's support the facts correctly.
Fantastic. Thank you so much, all three of you. That was such a useful session, especially at this time for all of our members. So we really appreciate you sharing your expertise with us on that. So thank you everyone for joining us today, and all the people joining us on YouTube as well. I really encourage you, if you'd like to find out more about the services of Blick Rothenberg or Borja Montero y Asociados, you have on the screen there. You can see all the contact information of James, Beltran and Alejandro, and also I will send a follow-up email around after the session later on today. You'll also have their contact details in there as well. So do get in touch if you'd like to find out more from them. And yeah, from the Spanish Chamber of Commerce, we're really pleased that you joined us for this, and we have a few more events still next week before we wrap up for Christmas. So please do feel free to check out our website to find out more about those. But yeah, thank you for your time, guys. Thank you.
Right.
Thank you very much.